All right, good evening, ladies and gentlemen. Welcome. I'm Phil Levy, Senior Fellow on the Global Economy here at the Council, and we are delighted to welcome one of the world's more insightful economic commentators this evening, Dr. Mohamed El-Erian, to our platform tonight. He'll get a fuller and more appropriate introduction shortly. After the program, Dr. El-Erian's newest book, a New York Times bestseller, The Only Game in Town, Central Banks, Instability, and Avoiding the Next Collapse, will be available for sale and signing from the bookseller. Tonight's program is the fourth event in our Global Economy series this fall. We have hosted Leo Brainerd and Carmen Reinhardt, and earlier this afternoon we welcomed Joseph Stiglitz. Coming up on December 6th, we'll have Sebastian Mallaby speaking about Alan Greenspan's legacy and lessons for the Federal Reserve. Beyond that, we have a few more exciting events. On December 7th, our Scholl Fellow, Victor Yuan, will discuss opportunity and entrepreneurship in China today. And on December 13th, Thomas Vukta and Robert Pape will explore how Europe's counterterrorism strategies have evolved in response to ISIL and lessons learned for the United States. Please note that this evening's conversation is on the record. Please silence your phones, but do feel free to use social media. Also, tonight's program is being live streamed and the video recording will be available online. For nearly a century, the Chicago Council on Global Affairs has provided an independent, nonpartisan platform for a variety of different voices to promote deeper global understanding and active U.S. engagement in the world. We convene leading global voices, and the views that they express are their own and do not represent either institutional positions or views of the Council. I'm going to return to the stage to moderate the audience Q&A a bit later, but for now, I'd like to welcome Ms. Ann Diaz to the stage to introduce our speaker. She is founder and CEO of Aragon Global Holdings, also a valued member of the Board of Directors at the Council. Please join me in welcoming Ms. Ann Diaz.
Thank you. Good evening, ladies and gentlemen. On behalf of the Council, I'd like to thank you all for joining us here tonight. I'm so delighted to welcome you, Mohamed, for all of us tonight to share your view on the future of the global economy. In recent years, it's become really apparent that central banks on their own have not been capable of fostering high and inclusive growth and durable financial stability in the aftermath of the global financial crisis. And according to Dr. El-Erian, we are now at a fork in the road for the global economy, and there are two paths ahead. Either we choose a path that leads to renewed prosperity and stability, and the other could lead to continued instability. So in this era of uncertainty, what can we do individually, institutionally, collectively to avoid the next collapse and to move ahead? So tonight, I look forward to Dr. El-Erian's insights on these very relevant topics. But before we begin, let me introduce him. He's the Chief Economic Advisor at Allianz and Chairman of President Obama's Global Development Council. Previously, he served as Chief Executive and Co-Chief Investment Officer of PIMCO and President and CEO of Harvard Management Company. He started at the International Monetary Fund, where he spent 15 years, and was also a Managing Director at Salomon Smith Barney Citigroup. Dr. El-Erian has published widely on international economic and finance topics. You may remember his bestseller right after the financial crisis, When Markets Collide, which was named a Book of the Year by The Economist, one of my favorites, and one of the best business books of all time by The Independent. He was also named one of Foreign Policy's top 100 global thinkers for 4 years in a row now, and is a contributing editor to a wide range of publications, the Financial Times, and also Bloomberg Views. Mohamed has many other active involvements on boards, the New York Fed, the Investor Advisory Committee on Financial Markets, but also Microsoft's Investment Advisory Board. Most of all, I'm also proud to call him my friend. So now, ladies and gentlemen, please join me in welcoming Dr. Mohamed El-Erian.
Thank you, Anne, and thank you, Michael, for inviting me. It's a true honor to be with you tonight. I'm going to pace because I actually hate public speaking. So I'm sorry that I'm going to pace. But let me tell you, we are living in quite a remarkable time. And what I'd like to do tonight is share with you a little bit about not just what and why things are happening, but also suggest that if we are going to navigate this fluidity in the global economy, in global politics, we're going to have to think differently. Now, it will come as no surprise to you to say it's been a really hard time and a very humbling time for expert opinion. Expert opinion has gotten virtually everything wrong in the last 12 months. At lunch, I was joking that suppose I had gotten up to you just 4 weeks ago, in front of you, 4 weeks and 1 day ago, and made the following two predictions. What would you have thought of me? I would have predicted that Donald Trump would win the presidency, and I would have predicted that financial markets would welcome this to such an extent that all major US indices would surge to record highs. Very few people predicted that Trump would win. And those that speculated about a Trump victory argued that it would be followed by a sell-off in financial markets. They were wrong on both counts. It's not just the last month. Let me take you 12 months ago. So suppose 12 months ago I would have told you that in addition to Trump securing the Republican nomination, a self-declared socialist in the United States would give Hillary Clinton a really hard time in the Democratic primary. Suppose I told you that over 30% of global government debt would trade at negative yields, which means if you're a creditor, you lend your money and you pay for the privilege of lending your money. That's not supposed to happen, but it was happening on 30% of government debt. Suppose I was to tell you that two central banks would take their policy rates negative. So it's not just about the markets doing strange things. Central banks, the most conservative institutions, would experiment to such a degree that they would take their interest rates negative. Suppose I'll tell you that even smart money hedge funds would find it very hard to navigate an environment in which correlations break down completely. Markets no longer behave like our textbooks tell us. And suppose I would have told you 12 months ago that the Cubs would win the World Series. By the way, being a Mets fan and having lived to 1969, when you guys were ahead of us by 9.5 points and then blew it, I've had a really guilty feeling for a long time, so I'm really glad you won. So I can go on. What I'm trying to tell you is not just the last 4 weeks that have seen improbables become reality. We've been doing this for a while. We've been living through a really peculiar time that if you paid attention, a lot of improbables and unthinkables have become reality. Now, when we face that, our human tendency is to dismiss these as standalone elements, as noise. I'm going to try to convince you tonight that that's a huge mistake. What I'm going to try to convince you is that the system is trying to tell us something. That there's a common element to every one of the things I've told you, except for the Cubs, but there's a common element to them, and that we have to take it seriously. And if you take it seriously, then you have to start thinking differently. Because even a bigger set of improbables and unthinkables are going to become reality in the period ahead. Okay, so let's start first with consensus. The consensus on the global economy was very solid till about 3 weeks ago. And it has changed in a really interesting way. Till about 3 weeks ago, we were stuck in a low growth world. My PIMCO colleague and I like to use, as far back as 2009, this concept of a new normal that suggests that we are no longer living in a cyclical world, that the Western economies aren't going to bounce back. It's going to be a very unusual period of low growth. This is now the consensus, and it has two much better labels. The IMF calls it the new mediocre, and the economists call it secular stagnation. But it has become consensus. So consensus number one is we are living in a low growth world, and it's stable. low and stable growth. Consensus number 2 is that central banks can repress financial volatility. That we can rely on central banks because, after all, that's what they've done for quite a long time. Low growth, financial stability. Consensus number 3, politics may be messy, but it's contained. Yes, our Congress doesn't function, but that's okay. Yes, you get Brexit, but nothing much is going to happen quickly anyway. So markets and the economy can ignore messier politics. That was a very strong consensus. Why? Because the various parts of the world that are systemically important were seen to be stuck in their own equilibrium. China, soft lands. Yes, it's no longer the locomotive of growth for the global economy, but it's a 5 to 6% annual growth economy, a soft landing there. Europe, not great, around a 1% economy, but somehow Germany keeps it all together. US, it's a 2% economy. We could do a lot better, but Congress is dysfunctional, and nothing's going to change. That was a very strong consensus. In the last few weeks, that consensus has been shaken by a series of remarks by the president-elect. Remarks, no actions, no design, just a few remarks. And I'll come back to why that is. But it's still the consensus. Now, the problem with that is that it's a really good description of where we've come from. It's a really bad prediction of where we're going. Why? For a simple reason. When you have low growth for a long time, and when the benefits of that growth are perceived to go to a small segment of the population that is already better off, people get angry. And then you get the politics of anger. And the politics of anger starts fueling very strange outcomes. Anti-establishment movements gain incredible traction. It's not that they need to gain office, which is what happened in the United States. They can change outcomes when they are nowhere near power. Think of the United Kingdom. The UK voted for Brexit on June 23rd. There would not have been a Brexit referendum had Prime Minister Cameron not worried about the base of his party ahead of the general election. So he promised a referendum in order to weaken a fringe party, an anti-establishment party called UKIP. UKIP has 1 seat in parliament. And yet UKIP resulted in a referendum that's resulting in a fundamental change in Britain's trading relationship. We are living through a period where the anti-establishment movements can change things even if they don't get to power. Or they can get to power, as we have seen here 4 weeks ago. So the notion that you can contain politics is being challenged by actual outcomes, because they're changing the parameters under which the global economy functions. The second thing that's happening is on finance. You cannot run a sophisticated capitalist economy at low or negative interest rates and not expect things to break. Things will break. The system is not constructed for low and negative interest rates. I'm not talking about the health of the banks. I'm not even talking about whether you get interest on your CD or not. All of us rely on products that provide us some sense of long-term financial security. Life insurance, pensions, other retirement products. With low and negative interest rates, it is very hard to provide these products to the population. So the longer you run a system, the more insecure people will feel about the future. You need only go to Japan to see what happens if you run it for a long time. People disengage from the system. And then it becomes much harder to manage the economy. So the politics starts shaking the consensus, finance starts shaking the consensus, and economics starts shaking the consensus. Why? The longer you run an economy at low growth, the more you pull down potential. The more you pull down potential, the less willing companies are to invest in plant, equipment, and people. So next thing you know, you end up reducing your own potential. So we have a system, a consensus, that is being shaken from above, by economic, political, and financial factors. And when that happens, institutions are mistrusted. They become political targets. And we've seen this happen with the Fed. That is what's shaking the world from above. We're also living through an incredible period where the world is being shaken from below. Let me give you a simple example, and then let me generalize it. Hilton Corporation. It took Hilton Hotels 100 years to provide 700,000 rooms to their customers around the world. 100 years, 700,000 rooms. Airbnb, 6 years, 1 million rooms. Now, in order for Hilton to do what Hilton did, they manage hotels, they construct hotels. Airbnb has no expertise in either of these things. They disrupted the hotel company from another world. They were never on the radar screen of Hilton, Starwood, Four Seasons. Why? Because they had attributes that were completely different. We're living in a world where you can be disrupted by people who know very little about your industry. Now, that's a really scary perspective. But they need to understand a few things. First, the empowerment of individuals. Anybody who has kids knows what that's like. Second, mobility. Third, big data. And fourth, artificial intelligence. If you understand these 4 things, you can disrupt almost anything. And we are just at the beginning of this disruption process. So if you look at the consensus, it's really hard to believe that it can be maintained when the world is being shaken from above and the world is being shaken from below. Instead, a much better representation is that the new normal, the new mediocre, secular stagnation is actually fueling so many contradictions and tensions that it's going to give way to something. Now, those who are willing to come as far as this say, but don't worry, that's central banks. Central banks somehow manage to maintain coherence when everything else doesn't make sense. They can decouple various parts. They can segment various parts. And it's true. They've done that for quite a while. The big pivot was in 2010. August 2010, we had just had almost 2 years of financial drama. The Fed had normalized markets. Markets were functioning fine, but there was no one to hand off to. The Fed looked around, there was no one to hand off to. If you remember, that was when the Tea Party was emerging. Congress was dysfunctional. It shut down government a few months later. And central banks looked, and there was no one to hand off to. So in August 2010, Mr. Bernanke, the then chair of the Fed, spoke at Jackson Hole and said, we are changing. We are no longer just pursuing market normalization, which they can do well, but we are also going to try and deliver macroeconomic outcomes. We're going to try to buy time for the economy, and we're going to take on this burden. To do so, we're going to use unconventional policies. And then he reminded people that unconventional policies come with, quote, benefits, costs, and risks. And the longer you apply them, the lower the benefits, the higher the costs and the risks. no one in the Fed, no one outside the Fed thought that central banks would still be in the business of unconventional policies 6 years after that speech. The idea was you were just going to buy time, maybe a year, maybe two. But repeatedly, when the Fed looked to hand off policies, there was no one to hand off to. Now imagine that you have a structural ailment of some sort, because that's what the global economy has had. It has had a structural ailment. And imagine you come to me as your doctor, and I say to you, you know what, I can't really fix it. You need a surgeon. But I can give you some painkillers. They're not going to work perfectly, but I'm going to help you through the next phase. Called QE2. That was the first painkiller. And you go away and you feel fine for a while, but after a while the painkiller is no longer working very well. The economy isn't really growing. Markets are getting a little bit nervous. So you come back to me and I say, look, I'm really not your answer. Your answer is the surgeon. And you tell me, but the surgeon up in Capitol Hill is paralyzed. So I double the dose. I give you Operation Twist, and then I give you QE3. And then you go away. And then you come back. At some point, you're going to worry about the side effects. At some point, you're going to say, are you hurting me more than you're helping me? Now, I, as your doctor, will never step away from you. That's not what I do. Central banks never step away from economic problems. I worked at a sort of global central bank, the IMF, and the message was always, we are in the business of solving problems, not creating them. So even if you don't have the right medication, you do what you can. So we have gotten to the point whereby the effects of central banks are felt much less in terms of benefits and much more in terms of costs and risks, or collateral damage and unintended consequences. In fact, you could put the central banks on a spectrum, where over here is highly effective. They just open their mouth, and the private sector does everything for them, because they're so credible. Over here, they're counterproductive. They open their mouth, and they get the exactly opposite outcome. You can place them on there. The Fed would be somewhere between effective and highly effective. The ECB would be somewhere between effective and less effective, and the Bank of Japan would be somewhere between ineffective and counterproductive. But the whole community is shifting away from highly effective, and that's why the Fed wants to normalize. And that's why the Fed, I suspect, is very excited about what they're hearing about Trump and seeing how the markets have reacted, because they have a window to raise interest rates and normalize. So what is this structural ailment? Why is it that we have been unable to grow? And why is it that central banks haven't been able to solve it? And the answer is quite simple. We fell in love collectively with the wrong growth model. We misunderstood what generates economic growth. I can take you 10 to 15 years ago, when the consensus at this point was that financial services were getting more and more sophisticated. They could enable more and more things. They didn't need much regulation. In fact, let's compete to be the financial center. London versus Frankfurt versus New York. And if you're not big enough, it doesn't matter. You can grow your financial sector to be a multiple of your GDP. Switzerland, Iceland, Dubai. And you can borrow, because after all, these people who are giving you loans are really smart, and they'll never give you a loan that you can't service. So they know more than you know. The love affair became so intense that we even changed the name of the financial service industry. We called it finance. And you can even go back and see that there were certain people arguing that it was the next level of capitalism. Agriculture, industry, manufacturing, services, and if you're really sophisticated, you get to financial services, you get to finance. The problem is finance enables, but doesn't create. Infrastructure creates. Education reform creates. corporate tax reform creates, labor market retooling creates. And these are things that central banks cannot provide. They simply don't have the tools. So we first fell in love with private finance as the engine of growth. Then we had the crisis in 2008. Then we had to rely on central bank finance as the engine of growth. We are yet to make the transition to genuine sources of growth. Put all this together, and we're coming to the exhaustion of this period that we've been in since the financial crisis. What comes next? The British have this notion of a T-junction. You're driving in the road, you come to a fork, as Anne said, but the fork looks like this. Now, what are the characteristics of this fork? One, the road you're on ends. You know that for sure. Two, there are two ways you can go. Three, there's nothing predestined about what you go. It's up to your choice. You can turn one way or you can turn the other way. That is the road we're on. If central banks continue to try and do it all, remain the only game in town, then it's only a matter of time when low growth becomes recession, when artificial financial stability becomes unsettling financial volatility, and when the politics get a lot messier. It's only a matter of time. And you've seen already the system tell you that we're getting close to that point. If, however, the political class responds, then low growth can become high and more inclusive growth. Artificial financial stability can become genuine financial stability. And the politics can get more collaborative. The good news is we know the engineering. This is not an engineering problem. If this room was full of economists, and I know that this will scare you, but if this room was full of economists, I'm willing to bet that most of them will agree that we need four things. They'll disagree on the relative weight, but they'll agree that you need to move on all four. One is pro-growth measures. Infrastructure spending, corporate tax reform. Two is better demand management. Where there is fiscal space, you should be using fiscal policy, as in Germany. Three, we have to deal with the pockets of highly indebted individuals and countries. Why? Not because we want to give debt forgiveness for the sake of it, but the system is better off for everybody. I'm thinking here of Greece, and I'm thinking here about student loans in this country that are going to become a real issue. No one likes to give debt forgiveness. It stinks. It has the completely wrong incentives. What do you mean? You're forgiving someone who was irresponsible? I was responsible, and you're forgiving them? You're going to make me irresponsible? Yes, I agree with all that. But when you have a crushing load of debt, as we found out in Latin America with the last decade in the 80s, it discourages any new inflow of capital because no smart creditor will come into an over-indebted situation. So you starve the whole thing from oxygen. And then you go into this awful thing. And those of you who listened to Joe Stiglitz earlier, he explained in quite a bit of detail how that happened in the Eurozone. And the fourth element, we've got to get serious about the economic architecture, especially if you're in Europe. You got to complete the economic architecture. You can't sell to the people a stool that has four legs that looks incredibly stable. Monetary union, banking union, fiscal integration, political integration, and then run it as 1.5 legs, a stool 4.5 legs. It gets really unstable. People don't like sitting on stools with 1.5 legs. They'll start voting in a strange way, including to exit various things. So we know the solution. We just need to implement it. Now, what's remarkable about the last 4 weeks is that the private sector is so keen to embrace this that it has responded already to the content and tone of what Mr. Trump has said since his election. If you were following the markets on election night, it was really interesting. Florida turned. Markets started getting a hint that this may be one of the biggest upset in our political history. And then people who said he has no path to the White House started saying, well, maybe he has a path, but it's not clear that it's more than a 5% probability. And then the other states started to turn. And suddenly the Dow was down 800 points, and the S&P futures were limit down. Then comes the acceptance speech just before 3 o'clock in the morning. And the acceptance speech was notable in two ways: content and tone. Content. The president-elect focused on the pro-growth elements of his program. He stressed infrastructure. He stressed deregulation. He stressed corporate tax reform. He did not mention tariffs. He did not mention dismantling NAFTA. He did not attack the Fed. So the first thing that the markets noticed is, wow, the content is pro-growth. Maybe he wasn't serious about that other stuff. And then the tone was incredibly inclusive. Again, surprising market. And opening the way for other politicians to be inclusive towards them. And suddenly the market said, well, so we have content that has certain elements of the solution, not all, certain elements. And we have a constructive tone, and we have the Republicans in control of both houses of Congress and the White House. We have the elements of the package here, and we have implementation here. And of course, markets took off on that. Nothing has been done. This is the ironic thing. Nothing has been done. We don't know the design. We just know the intentions. We don't know the design, and the design is really complicated. And we don't know about implementation. But it tells you that if the political class is to get its act together and is to take the burden of central banks and to pivot towards a more comprehensive policy response, the private sector will respond favorably. And I'm not talking about asset prices. It's nice for your 401ks. I'm talking about companies with trillions of dollars on their balance sheet that are not investing in extra capacity and people. So here we are, we're coming to this inflection point. If political dysfunction continues, we take a rather nasty turn. If the political class responds, we can take a good turn. And the only question is, what does it take for the political class to respond? Is this an endogenous shock, a shock within the political system, the anti-establishment movements? Does that wake up the system? Or do you need some sort of crisis to wake up the system? Now, this distribution, this is the last part of my presentation. This is not a normal distribution for you. You're about to be taken way out of your comfort zone if you haven't been already taken out of your comfort zone. Okay? Improbables becoming reality take you out of your comfort zone. Let me talk a little bit about distribution of outcomes. A T means where you are is the least probable, and the extremes are the more probable. It's called a bimodal distribution. Think of a camel with two humps. High here, low here. That is not how you function. The behavioral scientists have told us a lot, explained a lot about human behavior, and the most important element of human behavior is we operate well in normal distribution, bell-shaped distribution. That is how we operate, that is how you function most of the time. Why? It's incredibly comforting. A high probability of a certain outcome, and you have tails, really good things, really bad things, but they're low probability. You turn up here at 6 o'clock because you're expecting a talk. That is why you're here. High probability outcome. Was there a bad tail, a left tail as it's called? Yes, it could have been canceled and no one told you. Was there a good tail? Yes, you could have turned up here and had an amazing dinner. Okay? But you didn't plan on that. You planned on the most likely outcome. That is not the world that I'm describing to you. The world I'm describing to you becomes bimodal. Either we're going to tip into something much worse, or we're going to tip into something much better. So here's the bad news. If you continue operating the way you operate, you're going to fall into one of three categories where you don't want to be. Category number one, the denial. It's total denial. You have a blind spot. We all have blind spots. We're born with blind spots. And your blind spot is so strong and your unconscious biases are so strong that you don't even see it. You don't see a bimodal distribution. The second group of people are more like a married couple. They'll hear one thing and internalize something else completely. Okay, why? Because that's how we survive. We reframe things in our minds to make it more comforting. So I tell you it's a bimodal distribution. I tell you your flight from O'Hare leaves tomorrow, not at 2 o'clock as you normally leave, but you're either going to leave at 8 a.m. or 8 p.m. You go away and think, well, what did Mohammed mean 8 a.m. or 8 p.m.? That's not how flights function. A flight has a particular time. I wonder why he said 8 a.m. or 8 p.m. Maybe he meant the midpoint between the two. Maybe he meant a 2 p.m. flight. Okay? And then you become, there's a lot of science behind it. The third group is the worst. Okay? And the third group is where a lot, unfortunately, of the most successful companies end up. Let me give you a non-politically correct example, and then let me give you a politically correct example. And since Anne is originally from France, let me use France as an example. An American tourist goes up to a French person in Paris and asks for something in English. The French person either doesn't understand English or doesn't want to understand English, one of the two. So the French person says like this: what is the American tourist most likely to do? Repeat the question in English, but louder. Okay? That's called active inertia. Our brain tells us there's something wrong. But the inertia is so strong that you just end up doing the same thing. IBM, on the eve of the PC revolution, research has shown there was no doubt in IBM's mind that the PC was a major disruptor, that they had to do things differently. The strategy was barbelled. No longer operate where they're operating, but operate at two extremes. Enter the PC world, because that's where some of your clients are going to go, and that's where a lot of new clients are going to come in. And then migrate your mainframe up the value-added curve to be truly differentiated from the PC. There was no doubt as to what the strategy was. Less of what they were doing, and more of something new completely. IBM was the most respected brand in technology. IBM had the largest R&D budget. IBM was the most profitable tech company. IBM had the right strategy. Would you have bet on IBM? I would have. Well, IBM almost got eaten alive by Compaq, then by HP, and had they not completely re-engineered themselves as a service industry, a service company, they wouldn't exist today. Why? Because they understood the strategy, but when they came to apply it, they went back to doing what's comfortable to them. They did too little on the PC, and they didn't migrate the mainframe quickly enough. Okay? So the third group, the first group are the blind spot. The second group are the ones who reframe. The third group are the ones who believe they're doing the right thing and end up doing just more of the same. That is the reality of human behavior in front of bimodal distributions. But we know what it takes to do the right thing. First, it takes a lot of cognitive diversity. You need to be able to look at the problem from different perspectives. Cognitive diversity does not come without gender diversity, race diversity, education diversity. So cognitive diversity becomes a critical element to navigate a bimodal world. Second, scenario analyses, forcing yourself to ask the what if question, and not what can go well. We love talking about what can go well. Ask the question, what mistake can I not afford to make, and what mistake can I afford to make? That is really critical. Third, build in flexibility. You are likely to make a mistake. We are living in a world not of just uncertainty, but unusual uncertainty. Admit it. You wouldn't have predicted most of the things that have happened in the last 12 months. So of course you're going to make mistakes. The world is being shaken from above and from below. But you need to bounce back from these mistakes. So you need a certain amount of resilience, and you need a certain amount of agility. Let me end with an example of what it takes. And since Chicago prides itself to be a sports town, it's an example from sports. Not a sport that I follow, but it's a really powerful example. And it comes from Don Sull at the London Business School. In 1976, there was a very famous heavyweight boxing match held in Zaire. It was called the Rumble in the Jungle. There were two very different boxers. One was young, had won every single fight, was one of the most powerful heavyweights to ever come to the ring at that stage, and had knocked out most of his opponents. His name was George Foreman. If you watch late night TV, if you can't sleep like me, he sells barbecues on late night TV. The other was an aging boxer, way past his prime. At one point, he had floated like a butterfly and stung like a bee. He was too old to float, and he no longer had the power to sting. His name was Mohamed Ali. And the experts were in complete agreement. Not only would Foreman win, he would win by a knockout, and the only question was how badly hurt would Ali be? That was the only question being debated. You can watch the fight on YouTube, and in the event, Ali won by knocking out Foreman in the 8th round. So there's been a lot of research into this. And what this tells you is that the Ali camp recognized very early on that they were facing a bimodal world. The least likely outcome was what Ali had done for the last few years, which is stay in the ring, complete the 12 or 15 rounds, and hope to win on points. That was his strategy. That's how he had fought as he had gotten old. That was the least likely outcome. The most likely outcome was that he would be knocked out and hurt. And then there was a possible outcome that Foreman would make a mistake before Ali got totally exhausted. But they faced the worst of all bimodal distributions. Really bad up here, perhaps good, but down here. So they asked themselves, how do we change that? And they figured out it takes what I mentioned earlier, resilience, optionality, and agility. So the first thing they changed is they changed how Ali was training. Ali's, the poor guy, his training routine became appear in the ring and stand there and have former convict just hit you for hours. They were building resilience. The second thing they changed was the day of the fight. And you can hear it. It's incredible. You can hear it on the YouTube video. The fight starts, and everybody is expecting conventional wisdom. Everybody is expecting Ali to go in the middle of the ring and not be trapped by Foreman. Because Foreman is so powerful that if you trapped Ali, Ali wouldn't last a single round. Instead, to the shock of everybody, Ali gets up, goes to the edge on the ropes, and goes back like this and puts his hands up. And everybody said, he's a sitting duck, he's gone. What the Ali camp had figured out, because they thought differently, they asked, how do we deal with our new paradigm? They invented what's called today the rope-a-dope, which is using the ropes to diffuse the blows that you get. For 7 rounds, Ali depended on this resilience, keeping his optionality open. In the 8th round, there was a moment in which Foreman got tired and let his guard down, and Ali knocked him out. He used agility at that point. And it is this combination of resilience, optionality, and agility that's going to be absolutely critical if we're going to manage the growing list of improbables that are not just behind us, but in front of us. Thank you very much.
Well, thank you very much for that. That's great and very well told. Despite appearances, this is not going to be a conversation just between us. We're going to open this to the audience and invite your questions in just a second. But maybe I can lead off by following up on a point. You described the excessive reliance that we've had on central banks. When we've had rumors of retreat from that reliance in the past, you've had things like the taper tantrum, where just the mere thought that we'd get more normal interest rates sent markets scurrying. I think you spoke earlier about how there's now an almost certainty that we're going to start to see a rate rise in December. Are you concerned that we're going to get a repeat of this, or will the sort of new optimism about pro-growth provide sufficient cover that we can raise rates and get back to a more normal central bank stance without big, grievous injury?
So we've had quite a few episodes of intense market volatility that were triggered by some change in the paradigm, and then traders and investors realizing that there's less liquidity in the system and that the system doesn't accommodate everybody trying to do something differently at the same time. The big one was the taper tantrum, May 23rd, when Ben Bernanke suggested that the Fed would no longer be as supportive to markets. I was on the trade floor at that stage. He used the word taper. I remember people looking up taper to see what it meant. Okay. And then we had 6 weeks of complete market dislocations. Why? Because you were going to use, he had suggested taking away the support of the market with no handoff to anything else. Another episode is, people have forgotten it quickly, January, February this year, early this year. The S&P lost 9%. Why? Because we thought China was going to have a hard landing, and it wasn't clear what the handoff is to a stabilizing force. And that's why every time there's been market volatility, the central banks have come in to calm everybody down. Because the last thing they want is a market accident. If we raise interest rates, as you suggested, without a handoff in policy, then there's instability in front of us. If, however, we get a handoff in policy, then the markets will respond as they've responded. We have had a significant increase in interest rates, and yet the equity market has done extremely well. Why? Because the equities market is focusing on this policy pivot that has become more possible. It's not highly probable yet, it's just more possible. And that's what the market is responding to right now. So the key issue is, do you have something to hand off to? If the answer is yes, then you can hope to normalize. If the answer is no, then there will be financial market instability.
Very good, thank you. Let me invite questions then from the audience. Let's start right back here on the aisle then. I've neglected the instructions. Please wait for the microphone. And
sure, thank you. You talked about that we misunderstood the growth model, thinking there was a lot of growth in finance. I agree with that 100%. Then you talked about what it is we need to do differently to create value. The difference between Spain and Greece is Spain did invest in infrastructure, although they're still having trouble growing. I didn't understand where you thought the growth was going to come from beyond the infrastructure investment.
Okay, so we're talking about in general. So first is just supporting and enabling true drivers of growth. Infrastructure is an example of that, but so is corporate tax reform. We have a very antiquated tax system that has many elements of anti-growth. We have not had a major tax reform since 1986. What we've done is we've tinkered tremendously with the tax system. And the result of that is quite a strong anti-growth bias. Third, and more long-term, we need to take seriously education reform. Most studies show you that we are behind on that. Fourth, we, unlike some other countries, do very little on labor retooling and labor retraining. So there's a whole set of structural reform measures that enhance the ability to grow. That's the supply side. On the demand side, with the exception of a mid-session budget agreement, we have gone 7 years without an active budget. Now, I don't need to tell you that an annual budget is the most basic element of economic governance. But because we have had this polarization in Congress, we haven't had an active budget. We've just kept on repeating what we've been doing, and you don't need to be an economist to figure out that the world has changed quite a bit in that period, and you've given up on a very important demand management policy. If in Europe, you've got to make a decision. You've got to make a decision as to what sort of Eurozone do you want. Because what you have right now is not stable. Do you really want to commit to a Eurozone with the current memberships? And if you do, then you better forgive some debt. Because there is no state in the world, and that's a really strong statement, there's no state in the world under which Greece is able to grow with the current burden of debt. If alternatively you don't want to do that, then try and opt for a smaller Eurozone. But make up your mind what you want. Okay? And then finally, we got to take cross-border policy coordination and architecture much more seriously. We are at the lowest level of cross-border coordination, and we have massive interlinkages in the global economy. Right? So that is what you need. Now, the good news is you don't need a big policy bang, you need a small policy bang, because the private sector is pretty healthy. So it can respond to that. Ideally, you need it on both sides of the Atlantic.
Just to follow up on that, do you not think, though, that some of that international architecture has been the victim of this distrust of expertise? We've seen attacks on the TPP, on trade agreements, Brexit perhaps as one view of we don't trust them, we don't trust, the British saying they don't trust Brussels. Can that sort of survive this period of distrust and expertise?
So first, it's natural. I mean, think of just think of households. Something goes wrong, what do? You blame the neighbors. And if the neighbors are foreign, that's really good, okay? That is, that's basic instinct. It's not good, but it's what happens. So when an economy grows too slowly, and when the growth is non-inclusive, the benefits go to a small portion of the population, you start blaming. And what's the easiest thing to blame? Globalization, regionalization. TPP, it wasn't even in effect. How TPP could have harmed us when it has been ratified is something that I don't quite understand. Okay? But you do that. That's what you do. It's like if you're Russia and you're having low oil prices and you want to maintain political unity, go on a foreign adventure. Go and annex Crimea. It's the oldest political trick in the book. Right? Do something with someone external. So it's no surprise to me that protectionism and anti-trade and Brexit but it's an outcome, it's not a cause. Okay? It's happened because we've had this enormous growth crisis, and it has been an absolute crisis in terms of generating high inclusive growth.
Thank you. Next question, right here in the front row, please.
Thank you for your presentation. You described the type of things that need to be done in order to succeed. With a dysfunctional Congress that you described, and the unrest in Europe and the decisions about where Europe is going and other things, what happened if none of those things happen that you're describing? And worse than that, instead of having a Congress, we move to an executive order type of policies. What does then the central bank do, and how do we control the destruction?
So if we cannot get our legislative branch to step up to its economic governance, we are in a recession, we have financial instability, and the politics of anger get a lot worse. Okay? Whether it's here, whether it's in Europe, right? We are already on that path. Now, interestingly, we have a situation that we haven't had before. We have Republicans controlling or having majority in the Senate, having majority in the House, and another Republican in the White House. What's interesting is that since the election, there's been a lot more harmony between the Republican establishment and between Mr. Trump. So the new thing on and the reason why the markets have responded is they say, well, maybe we can unblock Congress. Maybe all we needed was an internal and endogenous political disruption. And that's what you've gotten. Now, you've taken it one step further and you said, what if the White House and Congress can't work together and we just go to executive orders? There's actually not a lot you can do with executive orders. You could do damage, okay, but you cannot deliver the list of things that I talked about through executive orders. You need Congress for that.
Thank you. Let's go more towards the back here. Actually, all the way in the back. There we go. Yes.
So how are they going to communicate effectively the sustainability of the growth from the fiscal policy? Because a lot of the problem with QE was, people didn't really believe that growth would persist after the policy ended. And then if you start to see like five-year forward trade above the neutral rate and stuff like that, why wouldn't corporations just buy back the debt that they issued to do their share buybacks rather than invest in PPE?
Okay, so first QE was a very long transmission mechanism. Compare infrastructure, where you're spending on labor, on materials, etc., to QE. QE is, I am going to buy certain assets in order to raise the price of other assets. So I'm going to take interest rates so low that I'm going to force you all to go out and buy equities. By buying equities, you're going to increase the price of stocks. Then you will open your 401ks and your fidelity statements, and you'll see that your wealth has gone up. So you'll feel wealthier. So I'm then going to trigger the wealth effect. Because you feel wealthier, you're going to go and consume more. And because you're consuming more, I'm going to trigger animal spirits on the corporate side, and they're going to invest more. That is a chain that has lots of leakages along the way, and the most important leakage is that people don't believe it's going to last. That's why this rally has been called the least loved, the most hated rally, etc., because everybody has recognized that central banks had a lot to do with it. So on the one hand, you had QE, which is a very clumsy way to try to generate growth, plus it benefits the rich. Why? They have the financial assets. Okay? So it's problematic in terms of its growth impact, and it's problematic in terms of its compositional impact. But it's the only thing the central banks could do. That is very different from infrastructure investing, is very different from corporate tax reform. That is much more direct. So the first issue, in response to your question, is it's a very different transmission mechanism. One is full of leakages. The other one is direct. Now, it could be misused. You could pick the wrong projects. And that's why I say design is really important. The second element is that as we've seen, the market can live with higher interest rates that are driven by a belief in higher growth and higher inflation. What the markets cannot live with is higher interest rates that are caused by an increase in the credit component. And that's what happened in Europe, in the credit component of interest rates. But if the market believes, if the stock market believes that you're going to get higher growth and you're going to get higher inflation, then it can do well even as interest rates are going up, which is what has happened over the last 4 weeks.
Let me just follow up then. What do you believe will happen with inflation?
So I think we're going to get to higher inflation. I think there's several things that are contributing to that. First, I think we're going to get much more active demand management. Secondly, as I hope Friday's labor market report is going to show, that wages are starting to go up at a faster clip. We're going to get much nearer to 3% and above 3% annual wage growth. And we're going to get back to a 2%, maybe slightly above inflation rate. But we're not going back to where inflation is a threat. We're going back to where inflation is more normal, right? And it's, I grew up in the 70s when inflation was a curse. And it was very funny to live in a world where the risk was too little inflation, right? Now, I think we're going to get back to more normal inflation, which is around 2%.
Thank you. Let's go right here, please. The microphone's coming forward there, yes.
Good evening. Why would you say that there's been this both a political and economic backlash against these so-called elites and experts, both here in the US and like what we saw over in the UK with the Brexit vote?
So I think it's a direct consequence of a system that provides benefits to just a few people. Okay? And it's a system that's viewed to favor the elites, that's viewed to favor the establishment, whether it's the public establishment or the private establishment, and the others feel marginalized. And I think that is what's happening. Go back to the primaries. And what you heard from Bernie Sanders wasn't that different, actually, in terms of economic content than what you heard from Donald Trump. They both attacked the establishment. They both attacked the elites. They both attacked the system that was co-opted. That's the word that was used most often. It was co-opted. They both attacked what I call the inequality trifecta, which is not just an inequality of income, an inequality of wealth, but also an inequality of opportunity. And the anti-establishment on both sides were actually very close in terms of assessment of what's wrong with the economy. The solutions differed, but the assessments were there. And I think we have to take seriously, because we're not going to go back to high growth overnight. We have to take seriously that a lot of damage has been created to the system. Right here, we are talking domestically. But suppose you're sitting in a developing country, and you say, well, let me get this right. I am part of a system that gives enormous privileges to the advanced world. The advanced world are the issuers of the reserve currency, which means I, India, I, Malaysia, I, China, give up goods and services to get bits of papers. They produce bits of paper, I have to produce goods and services. I give them the privilege of issuing the reserve currency. They also have the privilege of having the deepest financial markets, which means that I give them my savings so they can manage it for me in their instruments. And I also give them an enormous privilege, which is veto power in the most powerful multilateral institutions. Now, I'm willing to live in this system if the privileges I give to the core of the system, the US in particular, is matched with responsible management of the system. So that is an implicit contract that countries were willing to do all day long. In the last few years, because the financial crisis occurred in the US, occurred in the core of the system, there's been a loss of trust in the system. But you cannot replace something with nothing. So it's not as if countries can opt out of the system, but they're much less willing to engage with it. And they're starting to build small pipes around it. Okay? And it's fascinating because when you travel abroad, there's a sense that the global system is broken, that it no longer functions, that the middle is no longer responsible to it. Okay? And that's why you have this enormous uncertainty. So this discussion, the damage that we've created by not realizing early on that we're facing a structural challenge, and we needed to respond structurally and not just cyclically, and then we over-relied on central bank, is that we have created damage internally, and you see this in how divided the country is politically. You see it in terms of what has happened to the inequality trifecta, but we've also created damage to the system itself. People are less willing to trust the system. Right? And that goes back to your question, why is globalization gone from being something that we accept to being a political liability? Because of that.
You've talked about the importance of inclusive growth. Some might argue that there's a trade-off there, that if you talk about things like highly progressive tax rates, there can be a trade-off between inclusiveness and growth. Do you see it that way, or do you see this as complementary?
I see it mostly as complementary. I think we are a very long way away from the trade-off. At a certain point, the trade-off occurs, but we are so far away from it right now that I don't think I think you can have it both.
Very good, thank you. Right here in the center, please. The microphone's coming from behind you.
Hi, just to build on an earlier question, you talked about the essential ingredients for success and sort of questions around the optimal weighting. Obviously, it's not just the US that has to get this right. In the era of interconnectedness, there are other very consequential economies on the global stage that also need to get this mix right. Where do you see the weakest link? And kind of building on that, in the near term, where do you see the next potential domino that could fall? Is it the referendum in Italy? Is it the growing or continuing geopolitical instability in the Middle East, or the brewing potential instability in the Southeast, sort of the South China Seas and the various potential disputes there? Where's the weakest link, and what's the next impending threat?
So that's a critical question, okay? And it comes back to, can you be a good house in a challenged neighborhood? How many of you would buy a good house in a challenged neighborhood? And you have to have a lot of trust in either that the neighborhood is going to get better and or that the house is really exceptional. Because neighborhood effects have a way of impinging on the value of your house. So the global neighborhood is not that great. The US, whether you want to call it the cleanest dirty shirt or whatever you want to call it, the US in relative terms is better off. And we are about to enter a period where there's going to be a lot more dispersion in terms of economic performance, policies, especially monetary policy, and market performance. And you're already seeing that in the financial markets. Just look at what happened between the differential between 10-year treasuries and the Bund. We've completely broken a range that was there for a very long time. So we're entering a period where the US is going to go one way, and the rest of the world is going to be increasingly decoupled. Now the question becomes, what's the weakest? Europe, by far Europe. And events, Italian referendum on Sunday, Dutch election, French elections, German elections. Right? In a period in which the anti-establishment sentiment is very strong, and there you can question something as fundamental as what should your trading relations be, like Brexit. Now it's interesting, you're starting to see reinvention. I was talking to Anne. For me, what the French have done is, on the right, they voted in a surprise primary for an establishment figure running on an anti-establishment platform. And maybe that can reinvent itself. Be interesting to see what Mrs. Merkel does, because she's also going to have to deal with the anti-establishment movements in Germany. But to answer your question, the weakest link right now is Europe. Part of that is because, as those of you who attended Joe Stiglitz talk, they're part of a very inflexible structure, which isn't being made to work properly because there's not enough trust among its members, and they face a number of important political events.
We have time for one last question. Let's go right towards back over here.
If we're to believe some of the voices we hear coming out of the Trump camp, that they're going to do some of the things that you're advocating, infrastructure spending, tax reform, et cetera. But there's a lot of analysts out there who say, well, if you do all those things, you're going to start blowing a hole in the deficit, and it's going to go up. And you start borrowing more money, then interest rates go up, and that has a tendency to strangle borrowing and house purchases and all the things that go with it. So do we have to believe in the Laffer curve to buy all this?
So the simple answer is our debt sustainability is not being threatened right now, so we have got a window. And when you talk about debt dynamics, it's really, really important to remember that it's about a ratio, it's a fraction. We all focus immediately on the top line, which is our debt burden. How much do we have to pay? In what currency do we have to pay it? What is the maturity? What's the interest rates, etc. But debt sustainability is about the numerator that I just talked about, and then the denominator. How much can you generate in terms of incremental growth? Joe Stiglitz earlier this afternoon spoke about how the US ran a big government coming out of the Second World War and ended up with a debt to GDP ratio that went from 130% down to 40%. Why? Because it generated the growth. So as long as the deficit is funding growth-enhancing activities and design, I can't stress enough how tricky design is. Design is absolutely critical. But as long as that's happening, I really don't worry that much about debt sustainability. But if we're going to go on a binge of spending on stuff that doesn't generate growth, then that's a different issue. But it's really important to assess these things in terms of growth enhancement. To what extent do they enhance growth? If they enhance growth, we've got a lot of fiscal space. Now in Europe, there's even more space because they have negative interest rates.
All right. Ladies and gentlemen, that's all we have time for this evening. Dr. El-Erian's latest book, thank you. The latest book is available for sale and signing right over here. So thank you very much.